what we're here to talk about today is history, because history repeats itself, and there's a famous saying that those who don't study history are doomed to repeat it. So what we're going to talk about is specifically the stock market, because most of my clients are 65 to 85, and they are concerned at this point, being in retirement or close to retirement, that they don't want to lose a big chunk of their retirement nest egg again. That is their main goal, has shifted from high growth phase to more of a safety of principal and income phase of their life. Okay? And the concern I have is that the financial advisor that might have, or strategy that might have gotten you to retirement, is not necessarily the same strategy that you want to use while you're in retirement. It is a whole different ballgame. There's a study that said something like 90% of all rock climbing accidents happen on the way down the hill, not the way up the hill. And you'd think it'd be the opposite, but people are more careful going up, and then they let their guard down on the way down, and accidents happen. So what we're going to talk about today is looking at the history of the S&P 500 and the different bubbles that we've experienced and how that might be applicable to a retiree today. So let's look at history now. This is the last 18 years of the S&P 500 history. Obviously, past performance does not dictate future results. However, there are patterns that occur throughout history over and over and over again. So let's look at history. So the S&P 500, we use that because it's one of the biggest barometers of the stock market, and it gives us a good gauge on the stock market and the economy as well. Okay, so everyone remember the late 90s. We had the tech bubble. So from 1990 to the late 90s, we had a 10-year-long period of one of the best bull markets in history. Everyone remembers the roaring 90s, right? And what happened when that tech bubble, after the tech bubble, when it burst? So we had the tech bubble, and the tech bubble burst between 2000 and 2002, right? So either, if you made a lot of money in the 90s, unfortunately, many people lost a great deal of money in the early 2000s when the market went down and the tech bubble burst. Then we have the real estate bubble from 2003 to 2007, right? This is the real estate bubble. What did the government do to heal the economy back in 2003, or tried to heal it anyway? They lowered interest rates very, very low. Okay, as you remember, we had low interest rates in the 2000s, and when you study history, when we have low, artificially low interest rates, that causes real estate bubbles, because people can buy a home using a low rate mortgage, a lower interest rate mortgage. They can buy a more expensive home, right? So because their monthly payments are lower, so they can afford to buy a bigger home, right? So it kind of builds on itself, a real estate bubble, like all bubbles through history, whether we're looking at the Dutch tulip bubble of the 1600s, or the railroad bubble of the late 1800s, or the bubbles happen over and over again. Right before the Great Depression, we had the Roaring 20s. Everything's cyclical, right? And we had, the 90s, and since then, we're looking since then, right? So we have the real estate bubble here, and low interest rates, real estate rises. People, when their house is worth more, they're feeling good, they're feeling more confident. Sometimes they spend more money on average, and studies have shown, and they take money out of their house and refinancings, and they use the equity in their home. So it's kind of builds on itself that the economy gets better and the stock market goes up as well, right? Higher corporate earnings, higher profits is better for the stock market. It's a stronger economy, right? So we had 2003 to 2007, and of course this bubble burst, right? So we had 2008 and 9, the financial crisis, the last recession we've had, right? 9 years ago. So this was almost a 50% decline from top to bottom, approximately 50% decline. And again, many of my clients, before they met us, they had lost a great deal of money in this period of time. People often joke, unfortunately, their 401ks turn into a 201k, right? And so now, the difference is, though, most of my clients now, 10 years later or 12 years later, are much more in retirement or very, very close to retirement, and they never want to go through another 2008 and 9 again. That is their goal, right? So let's look at what's happened since then. So since then, we have 9 long years of a bull market, the second longest bull market in history, this last 9-year long period, right? Now, so what's interesting is, for every $100,000 you had in 2009 in March, okay, between then and before we had this pullback, the market is up approximately 358%. So every 100,000 in the S&P 500 has grown to about 358,000. And if you reinvested dividends, it's worth almost 400,000. So the great news is most of my clients are well above, or at least breaking even to where they were in 2007, right? So we've had 9 long years up, the second longest bull market in history, and we've had the first quarter of 2018, the S&P went down almost 10% in that period, the S&P and the Dow, right? We've had a big pullback, right? Now, we are hopeful that we have another year or two up in the market. Nobody knows, obviously. No one has a crystal ball. But we're hopeful that we have some more up in the markets. But again, no one knows. And historically speaking, on average, 4 out of 5 times these pullbacks are pullbacks to buy and they keep going up. But 1 out of 5 times they're pullbacks and they keep going down, right? And no one knows when one way or the other is going to happen. So we as retirees, retirement planning professionals, a retirement planning professional, my job is to make sure that if it turns into that 1 out of 5 times where it keeps going down, that we do very proactive measures, take proactive measures to make sure that our clients don't lose big chunks of money. That is the goal, right? So that's the story of the stock market history. I'm calling this the central banker's bubble, okay? Kiplinger has an article that I wrote. You can go to Kiplinger's website or you can go to my website, read the article of why I'm calling this, and my research shows that this is the central banker's bubble, okay? And why do we call it the central banker's bubble? Is because what did the government do here in America, for example, to solve the last financial crisis? They did 2 main things. This is a giant computer, by the way, so sometimes we have some technical, interesting things that come up. But anyway, so what did the government do back in 2009 here in America? And actually it happened around the world, but here in America, we lowered interest rates back to almost 0, okay, artificially low interest rates again, and the government did 4.5 trillion. They did 4.5 trillion in stimulus, okay? You guys remember QE1, QE2, QE3, QE4, twisting, you know, the twist, all those were stimulus, and $4.5 trillion with a T of stimulus went into the economy and essentially went right into the stock market, okay, to jumpstart our economy and get our economy back moving up, which is what everyone wants, obviously. So it's been very, very low interest rates for the last 9 years here, and almost 9 years. And obviously, if you're a retiree looking for safe yield, it's not easy to get today with interest rates at 2%, 1 or 2% in the bank, right? But the whole point of low interest rates is the government wants you to spend your money. You know, that's really their goal. They want you to spend your money because the more we spend, the better our economy does, right? So I call this the central banker's bubble because it's the $4.5 trillion of stimulus, the ultra low interest rates. Those are all types of stimulus that has stimulated where we are now, and I'm calling this the central banker's bubble. I do believe at some point this bubble will burst, and if you blow up a balloon large enough, they don't just deflate, they pop, they burst, right? So we don't know when that's going to happen, obviously, so we have to be careful and on our guard at all times, just to be ready for anything. However, we are hopeful we have some more time up, 6 months, 1 year, 2 years, 3 years. Nobody really knows, obviously, and we've had the new tax law, which is another form of stimulus, lowering income taxes, and again, to try to stimulate the economy and have people and corporations spend more money and bring money back from overseas. So that's, again, another form of stimulus that we're hoping will keep our economy moving forward and up for some time. No one obviously knows. And it's not just here in America that our central bank is stimulating the economy. Major governments around the world are also doing this as well. Japan, not only do they have the low interest rates, they've had negative interest rates, okay, negative, which means if you bought a 10-year Japanese bond, government bond, they literally will pay you less money than what you gave them. And people were buying those because they thought interest rates could go even lower. So Japan is negative and now, you know, almost zero interest rates. Several countries in Europe have zero interest rates or very, very low interest rates as well. So it's really happening around the world, this unprecedented stimulus. And it'll be interesting to see how this plays out over the next 3 to 5 years. So that's why I'm calling this the central banker's bubble. You can go to Kiplinger.com to see the article I wrote and get some more of the facts. You can go to my website, stuartplanning.com, S-T-U-A-R-T, planning, P-L-A-N-N-I-N-G.com, to get more facts. And you can also contact us to see how we may be able to assist you in creating a retirement plan that takes care of you for the rest of your life. Okay? A little bit about myself. I have my MBA in finance. I went to the University of Florida. I've been licensed in this field for 25 years. Since I was 18, I grew up in the business because my dad grew up in the business. He's been doing this for 46 years. Well, he didn't really grow up in the business, but he's been doing this license for 46 years. So he's got a tremendous amount of experience. I'm very pleased to have learned from him. He's a top agent in the field, financial planning. And so we have a lot to offer our clients. We have a lot to offer you. So if you're interested in getting a second opinion on what you're doing, we'd be happy to do that for you and let you know if you have too much risk or too much fees. You know, those are kinds of the two big things that we're really concerned about for a retiree. Why are we concerned about that? Because, one last point, because if you lose in the stock market 30% again, you don't just have to make back 30% to break even. You've got to make back 43% just to break even, just to get back to where you were, okay? And God forbid, if you lose another 50% again, you've got to make back 100% just to get back to where you are, where you were. And our clients, again, never want to go through that kind of a big downturn. That is what we are, our main goal is to, you know, protect what you have within using different strategies and techniques that are designed for more safety of principal and income than just simply high growth, okay? Because the more risk you take, the more upside, but also the more downside, which is what we're concerned about for our retirees. Last point I want to make is, if I get this work, good, okay, is the other thing about losses is this. So here in 2007, if you were in the stock market, like many people in 2007, and you invested there, let's say, it might have taken you 1 year, 2 years, 3 years, 4 years, over 5 years just to break even, okay? And this is not the first time. Here, if you bought at the top of the tech bubble, 1 year, 2 years, 3 years, 4 years, 5 years, 6 years, 6 years just to break even, right? So that's the point, is that when you're really close to retirement or in retirement, you don't have the time or the stomach typically to weather these types of 3 to 5 to 7 year downturns. Okay, so that's the point. We want to make some proactive changes to your portfolio, make sure it's in line with the amount of risk you're comfortable taking, and looking forward to working with you. Call us anytime at 1-800-807-5558. You can also, if you're in the Boca Raton or Fort Lauderdale or Palm Beach area, you can come to one of our dinner workshops. We hold them at Ruth's Chris Steakhouse and Abe and Louie Steakhouse. So welcome to come as well. No charge to learn more about us at Abe and Louie's or Ruth's Chris. Just call our office to find out dates that are coming up, or set an appointment with me so we can discuss your situation personally, see how we might be able to help and create a relationship with you, like we've been doing for 46 years here at Stewart Estate Planning. 1-800-807-5558, 1-800-807-5558. Pleasure talking to you. Thank you so much for your time. Looking forward to meeting with you soon. Take care. Bye-bye.